In this video, we're going to talk about how payday loans try to trap you in an endless cycle of debt. So hit that subscribe button and turn on the notification bell so you stay educated on how your money works. First, let's talk about what a payday loan is. A payday loan is a short-term, high-interest loan typically due on your next paycheck. Lenders know precisely when your next payday is because they monitor your checking account, and as soon as there's a large enough deposit, they'll automatically take back what they're owed. Payday loans are commonly capped at $500. Lenders charge fees of $15 to $30 per $100 borrowed. If you take out a payday loan of $500 on the first of the month with a finance fee of $15, on payday you'll owe $560. In most states, all you need to secure a payday loan is your ID, bank account information, and proof of income. So what makes a payday loan such a ripoff? Defining payday lending is like giving a tour of a gas station bathroom. It's hard not to pause every second to point out something sketchy. Payday lenders will call their $15 per $100 a 15% finance fee to deliberately mislead consumers into thinking they're paying 15% interest. This might sound good, even the average APR for a credit card is around 18%, but payday lenders' 15% finance fee is not interest. First, 15% APR on a $500 loan for a term of 4 weeks is just $6.25. A payday lender's 15% finance fee of $60 equates to $400 APR. So even if you're able to pay off your debt, you'll still get massively ripped off compared to other lending options. Payday lenders say they need to charge such insane rates because it mitigates their risk. And according to Pew, the average payday borrower makes $30,000 per year, and 58% have trouble meeting their monthly expenses. And unlike banks lending mortgages, payday lenders generally don't assess their borrower's ability to repay the loan. As a result, nearly half of the payday borrowers default on their payday loans within 2 years. So when you lend to a high-risk group, half of whom may default, it's fair to charge a little interest, right? Yeah, it makes sense, and it's entirely ethical to charge a teenager in a Porsche more for auto insurance than a preschool teacher in a Volvo. But payday lenders don't charge interest based on the risk. They charge the maximum amount allowable by state law. If your usual payday comes and there's not $560 in your checking account, you'll be subject to these fees. The first, a rollover fee. Your payday lender will start your $500 loan, tacking on another $60 for a total of $620. Second, they'll also charge a late fee. In addition to a rollover fee, your lender may charge you a $15 to $100 late fee. And third, the overdraft fee. Your payday lender will repeatedly try to withdraw the $560 you owe around payday, potentially resulting in multiple overdraft fees from your bank. As a result of this, the average borrower who takes out a $375 payday loan ends up paying back about $895. So how are payday loans so predatory? As a lending option, payday lenders are not even remotely competitive, charging 20 times the interest of the average credit card. That's like McDonald's charging $80 for a Big Mac. And yet there are more payday lender locations than McDonald's in the US, and how did they become so popular? Payday loans offer advantage over traditional bank loans or credit card debt. First, they're instant. Bank loans take 3 to 4 days to process. If you walk into a payday lender, you can have $500 in your account in 5 minutes. Second, there are no purchasing restrictions. To apply for a bank loan, you need to justify your expenses and plan purchases. You can spend a payday loan on anything. And third, they're available to virtually anyone with a paycheck. Over 53% of Americans have been rejected for a credit card, loan, or car financing due to poor credit, many of whom will turn to payday lending as a final option. In essence, payday lenders are well aware that they're a last-ditch effort for many desperate Americans looking to pay bills. They then use the opportunity to siphon as much money from them as possible. As I mentioned before, payday lenders charge borrowers the maximum amount of fees allowable by state law. Piling fees overwhelm borrowers so quickly that 80% of payday loans are taken out to repay another payday loan. So how is payday lending even legal? Payday lending is illegal in 14 states. In 1998, DC capped interest rates at 24% explicitly to push out predatory payday lending, and it worked. But still around in 36 states, and while legislators generally agree that the practice does more harm than good, regulation has been very, very slow. So for the time being, interest rates remain at 391%. And the best things any consumer can do is take a look at your finances. So what are your thoughts? Are you in the process of getting a payday loan? Are you thinking about getting a payday loan? Is a payday loan your last resort? Leave a comment down below and let's get a discussion started. And as always, take care of your money. Today's book of the day is The Intelligent Investor by Benjamin Graham. I'll leave a link to the book down below, and if you prefer listening to it on an audiobook for free, I'll also leave a link to a 30-day free trial to Audible. You can choose this book or any book to listen to, and even if you cancel before your free trial is over, You can still keep the book and listen to it whenever you want. Last thing before you go, a financial education is the most important kind of education you can give your kids. That's why I created Smart Money Parenting as a way to prepare you and your kids about the highs and lows of managing your own money. I'll leave a link to the course down below so you can check it out.